There was an individual looking at their Discover card statement, and on their Discover card statement, it showed their FICO score was a 696. Well, they were really jazzed up about that. The realtor was excited. The lender was excited. Everybody was excited, thinking they're about to be able to qualify for a house. A week later, they found the perfect house. Now they want to go in there and put in a bid. The lender pulled the FICO Classic score, and guess what? That 696, yeah, it dropped to a 602.
All right, everyone. Thanks so much for joining this, our session today, all about credit basics and credit repair. It's going to be high level, but packed full of information, and we hope you find it incredibly helpful. My name is Alyssa Caliendo. I'm a senior mortgage loan officer at CrossCountry Mortgage. I run a team called the Caliendo team, and some of you are past clients of mine. Some of you are new contacts, but in any case, we offer mortgage financing, residential mortgage financing for up to 4 units, and are always happy to answer any and all loan or home financing questions that you might have. And we are joined today by Stephen Robert. He is phenomenal. He is my go-to for all credit questions, client referrals, etc. He is the CEO of Bedrock Credit America, which I believe is a nonprofit. Is that correct, Stephen? Okay, that's what I thought. And he is going to lead us through a lot of helpful information tonight, and we will be sure to leave time for questions if there are any at the end. So, Stephen, feel free to take it away.
Excellent. Well, thank you so much, Alyssa, for having me on tonight. I'm really excited to talk about this. I've been doing credit education and credit repair for the past 19 years. So tonight, we're really kind of peel back the onion about what is credit really all about? What are the ins and outs of it? Like you said, we're going to kind of keep it high level, but leave with a lot of good information here so that anybody watching this can really understand what credit is really all about. So we're going to dive into it real quick in terms of just the basics, which is the credit bureaus. The credit bureaus, known as Equifax, Experian, and TransUnion, are data warehouses. While we as consumers go out there and we pay our bills on time, well, hopefully we do, and we have mortgages and we have car loans and we have credit cards and we have student loans, as we're going and we're making our payments on those accounts, that information is being sent over to the credit bureaus. The credit bureaus are holding that data, and that's really all they're doing with it until somebody requests that information. And once they request that information, they're going to be putting that data into a scoring model. Not all scoring models are created equal, as we're about to talk about in a moment, but that data generates those scores, it generates the reports, and then we can kind of see, is this type of person the type of person that the lender wants to be able to give a qualification loan to? What type of interest rate do they want to give them? All of those parameters are based off of that history that the credit bureaus are holding. So that's just kind of the quick overview. Any thoughts on that, Alyssa?
No, I just think it's important that people know that we are going to be looking in some cases at all 3 bureaus, but at least 2 certainly. And they do report differently, or their scoring models, I should say, are differently. All of your trade lines should report the same. We are going to look at all of them. So we're not just going to look at whichever one is the most favorable. It is really helpful to have a good handle on where you stand with TransUnion, Equifax, and Experian.
And I couldn't agree more. The amount of times that people said, well, I was monitoring Experian and it looked good, and then the lender pulled my report and it said all 3 bureaus and TransUnion and Equifax were terrible because all this extra data or this negative information was being sent to those bureaus and not Experian. So I fully agree. Managing and making sure that you're looking at all 3 bureaus is absolutely paramount. The other thing that's absolutely paramount is to not use free credit reports and free credit scores, and I put those in air quotes for a very specific reason, is because the information that these free websites give you is not accurate. The scores they give you are wildly inaccurate. And how are they making their money if they're giving you all this great information for free? Well, they're selling your personal data. So we really want to stay away from all these different websites that are giving you these free reports and free scores because they're really not giving us accurate information. What we do want to do is use these one of two websites, as you guys can see on the screen. We have annualcreditreport.com. Annualcreditreport.com is an absolutely free service. You can go there on a weekly basis. I know it's called Annual Credit Report because it used to be one time a year you could see your credit. Now it's every week you can see your credit. It gives you access to all your data at Equifax, Experian, and TransUnion for free. It doesn't count as an inquiry. It doesn't hurt your score in any way, shape, or form. However, it's not going to give you any scores. So the point to do this is really just to be able to see your data. If you do want to see scores and you're in a position where you think you might want to try to qualify for a home loan, that's when you obviously speak with Alyssa. Alyssa can pull credit and she can walk you through that side of things. But what if you want to look at your own credit and make sure that you're getting the accurate information? Well, the accurate information comes from myfico.com. myfico.com. Myfico.com is the only legitimate website I ever recommend in terms of being able to see your scores. Because not only is this giving you credit scores, most importantly, it's giving you FICO scores. And by going to myfico.com, you get all the data from Equifax, Experian, and TransUnion. It's not going to count as an inquiry. It's not going to hurt your credit in any way, shape, or form. But because you're going directly to the source, you do have to purchase it, and the cost to do that is $30. Now, some of you are probably thinking, you know what, Steve? I've heard about these tricky FICO scores, and it's okay because on my credit card statement or on my bank statement, it shows me my FICO score. So I'm all set. I have the same information the lender's going to use. The problem is that's not accurate. And for those of you scratching your head going, well, that doesn't make sense. You just said it was a FICO score. Here's what you have to understand. There's 4 versions of your FICO score, okay? What all lenders have used over the past 26 years is known as FICO Classic. That is the gold standard. That is what all lenders use, and that's all of what lenders have used in the past 26 years. Well, since then, in 2008, they built FICO version 8. In 2014, FICO version 9. In 2020, FICO version 10. So they keep building newer versions. They keep passing these out to the public. And that's what you're going to see on your credit card statement or your bank statement, not the FICO Classic. And for those of you thinking, all right, well, that's kind of weird that there's all these different types of FICO scores, but it's a FICO score, right? Like I get a credit score, maybe it's different, but a FICO score, no matter what version it is, has to be similar. Well, check this out, guys. This is a real life example. I tried to make it as big as possible. Hopefully you can see this. This happened last year. There was an individual looking at their Discover card statement, and on their Discover card statement, it showed their FICO score was a 696. Well, they were really jazzed up about that. The realtor was excited. The lender was excited. Everybody was excited, thinking they're about to be able to qualify for a house. A week later, they found the perfect house. Now they want to go in there and put in a bid. The lender pulled the FICO Classic score, and guess what? That 696, yeah, it dropped to a 602. So just absolutely wild, the misinformation that's out there where you're thinking, oh, look, I'm seeing a FICO score, and then you get into this situation. And Alyssa, I'd love to get your thoughts on what is the difference if you have a 696 versus 602?
Yeah, it's really going to be limiting as far as the programs and the products that you qualify for. It could change the down payment requirements. It could mean not qualifying for any sort of down payment assistance if you're a first-time home buyer who would otherwise be eligible for that type of offer. And so this is critical for people who have concerns about credit. And there are many customers who do. It's one of the first things that I ask when I do an initial intake call with a client, regardless of their timeline to buy. One of the basic high-level questions is, do you have any concerns about your credit score or your credit history that you think I should just be aware of up front? And usually, people will be prompted to share quite a bit when I ask that question. And if they have hesitations about their score, if they don't really know what their scores are, if they've only looked at them through some type of credit card monitoring service or other free monitoring service, and they're worried about what the scores are going to be, I always recommend that they take a look at those scores on MyFICO, especially for people who are reaching out who say, I'm not in a position where I want to get or need to get pre-approved right this moment, but I think I really want to buy a house next year and get serious about it. I've done some work on my credit. I know I still have some work to do. It's really helpful to get this baseline 12 months in advance so that if there is still some rehabilitation that needs to happen, you have plenty of runway to do that. And it doesn't have to become something that's stressful when you're already out shopping for a home, or maybe you're already under the gun to get into a property because of your timeline. You have a lease that's expiring and you feel a lot of pressure now to get into a home, and maybe you don't have the time to improve your scores. And so then we are just going to have to evaluate the products that are available if you had a 602 as your mid score, for example. So it's $30 to get this comprehensive report, to get a handle on exactly what your scores are for mortgage purposes. Whatever score results you get from my FICO for mortgage purposes are the exact same scores that I would get if I went in behind you and pulled credit on your behalf in connection with an application. So you can absolutely rely on the information that you receive from this site. And I think $30 is a pretty small price to pay, either to have the reassurance that everything's all good, or to have a real handle on where things stand and what you need to do to improve.
Absolutely. I couldn't agree more, because when people ask me, when should I be looking at my credit? Now,
Yeah.
today, right? Because if there's issues, or that you have to build credit, you have to fix credit, that could be a 6 month, a 12-month process. Best case scenario, you spend the $30, your score's in the 800s. Well, now you can sleep good at night, right? And you
Exactly.
just want to continue doing more of the same. But you're
thirty
absolutely correct.
dollars $30 is like, I think, two value meals now at a drive-through. So with
That's true,
prices
right?
nowadays. So it's
Yes.
really not that large of a spend for you to be able to get some clarity, real clarity about where you stand with your credit scores.
Exactly. And the peace of mind that it can bring you. And to that point, I mean, there are situations where people are younger, they're just starting out, they haven't really started to develop their credit yet, or maybe they're in their 30s, 40s, 50s, 60s, 70s years old, and they've had credit issues. They've gone through divorce, medical things, job losses. Life happens. We get that, right? So if you do have issues, we're going to need to talk about how to deal with those. We'll get there in a moment. But what about building credit if you're not really have the good credit history yet, or you just haven't developed your credit history yet? How can you actually go about that? And there's really two ways to do it. The first is through a secured credit card. So a secured credit card is a little bit different than a regular or unsecured credit card, because that regular or unsecured credit card actually is giving you the ability for you to put the money up front. And because you're giving the money to the bank up front, they're going to be much more likely to give you the approval so that you can actually start proving to yourself, based on the fact you don't have any history or not very good history, and start saying, listen, I'm going to show you here's $300, $200 in advance. Now I have a credit card with a $300 limit. I'm going to put $20 out every month. I'm going to pay the bill in full, and I'm going to prove to you that I can start showing that I know how to pay the bills on time. And every month that happens, you're building and establishing that positive credit history. And that's a beautiful thing. The best part about this is, after 12 months, they say, you know what? You really have proven yourself. Here's your $300 back. You get that back. Now it turns into a regular credit card. They increase the credit limit, and you continue to build the history with that card. So the secured credit card is a wonderful way to start standing on your own 2 feet, to develop and build some history. On the other side of that is the authorized user relationship. And this is kind of where you're leaning on somebody else's credit. But if you have a friend or a family member, and that person has a MasterCard or Visa, not American Express, but if that friend or family member has a MasterCard or Visa that's been open for the past 5, 10, 15 years, and you get added as an authorized user onto that card, well, within 30 days, that 10, 15 years of positive credit history shows up on your credit report. And as long as the balance is nice and low and it's always been paid on time, it's going to help you. But this is where we really need to understand how this process works, because I have seen an enormous amount of people on TikTok and Instagram that are giving all this bad information about get out as an authorized user, get out as an authorized user. You're guaranteed to help you. Well, I literally just had a conversation a couple weeks ago where this girl said, yeah, I'm trying to help my credit, so I got added to my boyfriend's credit card. Well, the credit card was a year and a half old. He was maxed out on it, and he was late last June. So tell you what, that's not helping. So the concept of being added as an authorized user, although it can be very helpful, you have to understand how the process actually works within that card, because just being added as an authorized user, there's no value there if the card isn't a strong enough card. So my advice in that situation, just so you guys understand, was get yourself off this card. It's not helping you. Let's have you start developing your own credit, because that's really what needed to be done.
And I see people all the time. I mean, it really runs the full gamut. I think credit a lot of times can be taboo, but I had what I would consider to be very sophisticated buyer by general standards a couple of months ago. They're an attorney at a big law firm, and they've always been very financially responsible. And they just thought they were in a great position with their credit scores for mortgage purposes. We went to pull their credit, and they were an authorized user still on a card that their parents had from years ago. And their parents use their credit card for everything and then pay the balance off completely each month. Well, the timing of when we actually pulled credit, they had a significant balance on that card and high utilization, and it impacted our buyer's credit scores. And she was confused, upset, kind of furious about it. And of course, the parents can go ahead and pay down the balance like they typically would in the normal course. But she had no idea that that was even part of it. She wanted all the benefits of being an authorized user with none of the downside, and really didn't understand how it even worked. And I'm sure that she was added to that count years and years ago to help her build credit. And that's a great thing, right? But I would say do it responsibly. If you're getting added as an authorized user to an account now, whether it's a friend or a family member, yes, it's going to help you, but it's not too much or too prying to kind of get a sense of how this card is utilized. What type of balance do they normally carry? Do they pay it off in full every single month? Have they been late? Because depending on the answers to those questions, you might not benefit from being added as an authorized user. It could work out fantastically. It's just important to be fully informed.
Yeah, fully agree. And that's a great example of real life of you think you're helping your son or your daughter, and just by you going and spending and putting money on there, it actually could be detrimental now when they're trying to go and qualify for a home loan. So if we now take a deeper dive into, okay, what actually goes into our FICO score, these are the 5 components. Now, again, we're not going to go all the way in. We're not going to dissect them, but I am going to talk about some of the major things that I see on a daily basis where it's causing problems for individuals that are trying to get their credit headed in the right direction. So we'll do a just kind of an overview of each one, and we're going to start with the past delinquencies because that's 35% of our score. So our payment history and your accounts being paid on time really basically is going to dictate what happens to your score. And the amount of people that have perceptions of, oh, well, I had 1 or 2 late payment, it's not going to impact me that much. The amount of times people have said, oh yeah, like, yeah, I got a late payment, so maybe my score went down 10, 20 points. No, how about 50 to 80 points? They're like, what? I'm like, yeah. And by the way, it can stay on there now for 7 years. What? I mean, people don't understand the importance of making sure that your accounts are getting paid on time, because one late payment can just really trigger, and kind of like what I was showing you earlier, it can pull you from a 700 to a 650 or even lower. I mean, to have a 50 to 60 point difference between your scores simply because of one late payment, it could change your type of program you can qualify for, the interest rate you're going to get, all of that. So we really do want to make sure that we're monitoring our credit and we are making sure accounts are getting paid on time. With that being said, I understand life happens, and sometimes all accounts can't be paid on time. So they might go 30 days late. They might go 60 days late. They might even go 90 days late, 120 days late, 150 days late, or even 6 months late, leads to something known as a charge-off. And a charge-off, by the way, let me just be very clear about this, a charge-off does not absolve you of the debt. Many clients will come to me and say, well, yeah, it says a $2,000 charge off, but I guess they charged off the debt, so I don't have to pay it. I'm not responsible for it anymore. That's not true at all. It just means they've stopped reporting you on a negative monthly basis, but that overall debt, that $2,000, that still needs to get paid. And if it's not paid, they're going to turn around and they're going to give it to a collection company. A collection company is going to throw themselves on the credit report, and then they're going to make the credit even worse. And if the collection company is not getting their money, what are they going to do with it? Well, they're going to give it to an attorney. The attorney is going to go out there and try to freeze your bank accounts or garnish your wages. So we really want to make sure that if there are situations like that, that we're taking them seriously and we are addressing those issues within the context of what we're looking to do. And Alyssa, I think you can maybe speak a little bit more about this in terms of accounts that go into charge off or collection, and do they actually all have to be resolved before we can actually get an approval, or are there situations where maybe sometimes it can get pushed into the DTI, or it doesn't even need to get paid, or if it does, it can get paid at closing?
Yeah, it can be any one of those options, and it really all depends on your profile, your overall profile, and the loan product that you're seeking, which is why it's so important. Even if you don't think you're going to be in a position to buy for 6 months, 12 months, to start having a conversation with a lender as early as possible. We can get a handle on these things with just a soft credit inquiry. We don't have to do a hard inquiry on your credit at the pre-approval stage. And so we'll be able to determine if you have charge-offs. Maybe depending on your overall profile and the product you're interested in, it's no problem. It's irrelevant. Yes, we see them on there. It's not going to impact anything. For some programs, you need to pay those in full by closing day, or else we can't access that product, that interest rate associated with it, whatever type of specialty feature there might be. With collections, we might not have to worry about it in certain circumstances. We are going to have to factor in some amount of that collection into your overall debt to income ratio. Again, it depends on the product that we're seeking. And if that collection is a very, very large outstanding balance, we have to take a percentage, usually it's 5% of that balance, and treat it as if it's a monthly payment obligation for you. Now, maybe you're not tight on your overall debt to income ratio, and so doing that isn't going to impact your ability to buy a home at all. But maybe you are, and it actually is going to be the difference between you being approved for a loan or not being approved for a loan. And so the more time that we have to be able to grapple with these items, strategize, talk to you about how we might be able to resolve them, or just be able to take a look and say, you know what? We know that they're on here, we can see them on here, but you're actually fine and it doesn't impact anything, the better off you'll be, because you don't want to be having those conversations again. It's kind of like finding out you have a low credit score once you already found the perfect house. If we're having those conversations for the first time when you've already found the perfect house, now generally speaking, you've probably got 20 to 45 days until closing to get this resolved. That doesn't give you a whole lot of time to come up with the money if we're talking about paying these off in full or you not being approved for a house.
Absolutely. And that's why Alyssa, I really appreciate you and how diligent you are. And let me just be very clear to everybody that's watching this. Not all lenders are created equal, and Alyssa is on top of this. And I love this. And I'll give you a real life example of this, because this is a situation where you are offering so many different solutions based on what the client is looking to do. But some loan officers, not understanding how the system works, will give misinformation and actually cause more problems. The biggest thing that I see that most people in general have the basic concept of is that, or thinking that the basic concept of would be helpful, and then it turns out not to be, and that's paying off our debt. So this is where we have these conversations directly with the lender first and really clarify what actually does need to be resolved. But if something does actually need to be resolved, when do we resolve it and how do we resolve it? And making sure that we understand that by resolving issues, there actually can be a detriment to the score. The reason that happens is because of these three letters known as DLA, which stands for date of last activity. The date of last activity, in terms of how the FICO scoring system is built, means how much something's going to impact your scores. So if you have, let's say, an open collection and it's 4 years old, and now the client goes and pays it, and it goes from an open collection 4 years ago to a paid collection as of now, that's not going to actually help your score. That's going to hurt your score, because what you're doing is taking something that's really, really old and you're making it a more recent event. And when the clients go and try to fix the credit themselves, or if they're getting misled by getting bad information, then that can become a huge problem. And the example I have is that last year there was a gentleman who went to a lender and he had 4 open collections. And the loan officer said, yeah, just go ahead and pay these 4 collections and we'll get you approved. Not really understanding, or like to your point, Alyssa, really seeing if there's different parameters for them to be able to do things. And what ended up happening was this gentleman paid his 4 collections. And by doing that, guess what? His scores dropped 82 points, and then he wasn't able to qualify. He ended up getting pushed or walking away and going to another lender by September who actually knew who I was. They referred them to me, and I was able to explain to the client, listen, you got bad information. You've now paid these debts. You made them more recent. And because of that, that's why you saw the drop in the scores. And it was going to take a lot longer to get the scores back up because of how the debts were paid. So it's just a prime example of making sure that you're working with a lender that really understands what your options are, number one. And number two, if you do need to pay things, making sure that they're getting paid properly so that you are financially protected, but also giving us the ability to move forward.
Well, and
Any
I'll
thoughts on that?
always make sure too that if it's a situation that's not completely straightforward, or there's a lot of past delinquencies or credit blemishes, let's call them, and we've got a few different variables working in concert, I always make sure to connect those clients with Stephen so that we can get trusted advice from the professional. I like to stay in my lane. My lane is mortgages, Stephen's lane is credit, and I'm going to always defer to him when it comes to recommendations on what you can do to improve your scores as quickly as possible or on a stated timeline. And a lot of people, I think, too, if they've had late payments, they have collection accounts, charge-offs, they've never reached out to a loan officer before to talk about a mortgage, and they're nervous and they don't want it to seem like they're financially irresponsible. So what they'll do is they'll go and take care of those things before they give me a call. And they'll be like, oh, I had these things in the past, but don't worry, I just paid them all off. And I'm like, oh no, oh no. So you can always do that. You can always pay them off after you speak to me. We can always refresh credit reports and get updated scores pulled in if we need to down the line. But make sure that you reach out to a loan officer first. Make sure that they have a trusted credit advisor who they work with. If you've got things that you're worried about, who they can connect you with. We do it constantly. There's nothing that you could tell me that I'm going to be judgmental about. People have all different reasons for being over leveraged or being late on payments. I've had clients before who have lost young children unexpectedly and then had issues with employment because of bereavement time, and or they're in a position where they were just really really young and they didn't understand credit cards, and they took all the credit card offers that were given to them by solicitors when they were in college. It happened to me too, and got themselves in a really bad spot with that stuff. So there's nothing that you're going to tell me that I haven't seen or heard before. Everything from the most normal and common to the craziest story. It is what it is. You've got the credit scores and the credit history. We just need to contend with it. And you might actually be surprised what kind of credit scores and history you can have and still qualify for a loan without having to take any other action. So definitely reach out and have a conversation with me first before you go making any payments or taking care of these items, because it might actually delay your purchasing timeline inadvertently.
And that's a great point, is that you don't have to have perfect credit, right? Perfect. Oh, I want to clean everything up so I have the best credit possible. Perfect credit so I can qualify. There's situations where you can still qualify and you don't have the best credit possible. But also to your point, Alyssa, you want to make sure that if you do try to resolve these debts, or you have to resolve these debts, you do it properly. And what you don't want to do is start calling and paying these accounts over the phone. Don't ever give out your debit card, credit card, or checking account information. And certainly don't do anything unless you have a document in writing. So part of the process that I kind of instruct the clients with, or could also help them with by representing them as a power of attorney, is contacting the creditors, verifying that debt, negotiating that settlement, and getting that settlement letter in writing. And now when we're ready to actually make the payment, we pay it with a money order or a certified bank check only. No debit card, no credit card, no checking account, because if financially they have your information, they're going to use it and they're going to give it to other creditors, and it's going to become an absolute nightmare. So you really want to make sure that you are financially protected and you have all the correct documentation before you do anything. But again, only do something if absolutely necessary, and speak with somebody like Alyssa as a lender that really is going to be able to explain to you, is this something we have to tackle right now, or is it something we can still get you the loan and we can kind of maneuver around it? So with that being said, the next category here is 30% of our score being debt ratio. So debt ratio, a little bit different than what Alyssa was just saying with debt to income ratio. And Alyssa, you can certainly talk a little bit more about that debt to income ratio. But from a credit perspective, what I care about is debt ratio or debt utilization percentage, right? So how much money do I owe versus my limit? So if I have $1,000 limit and I owe $1,000 on that credit card, well, I'm maxed out. And having a maxed out credit card is going to hold my scores down. It's going to hold my scores down now. And at the very end, I'm going to give you a sneak peek about the upcoming changes. And we're going to see that it's these upcoming changes have a lot to do with how we're managing our credit cards and our revolving debt. And that if we're not starting to make changes now, it's going to become a huge problem in the near future. But in terms of what we're currently dealing with, we want to make sure that we're maintaining nice low balances on our credit cards, and that if we are putting more money on our credit cards, that we're trying to pay it down as quickly as possible. Now, for those of you thinking, yeah, you know what, Steve, I have a credit card and I have $1,000 limit and I max it out every month, but that's okay because the day I get the bill in the mail, I pay it in full, so everything's good to go. Well, here's the problem with that. The credit card companies only update the credit bureaus one time per month. So the day they send you the bill, whatever that balance is, that's what's going to go sit at the credit bureaus for the next 30 days. So if they send you a bill and you have 100% utilization, and that's what gets sent to the credit bureaus, well, it doesn't matter that you pay your bill in full the day you get it. And you might think, well, my balance is zero, so I'm good to go. But the credit bureaus still think you're maxed out. And now you're sitting there with a zero balance. What are you going to do? Well, you want to put money on your card. You have to spend, you have to do groceries, gas in the car, all that stuff. So now you're going to put more and more money on the card. And then all of a sudden, by the time the next billing cycle comes through, you owe $900 on your $1,000 card. You're at 90% utilization. And again, that information gets sent to the credit bureaus. And we get stuck in this perpetual cycle of having a high utilization. And that high utilization causes problems because now it's meaning higher debt utilization is holding our scores down now, as well as the upcoming changes. So if you are going to put money on your credit cards, try to make multiple payments throughout the month so that you're maintaining low balances by the time the billing cycle comes through. Or if you can, in an optimal world, only put $50 or $100 on your credit card every month and you pay it in full. By doing that, that will maintain that lower utilization percentage, which will optimize the scores. Alyssa, any thoughts on the DTI versus debt ratio? Does that come up for you ever or not really?
Not really. Debt ratio, though, I think is important for you guys to understand, and everything that Stephen just walked through. We have to have those conversations with clients all the time too. Oh, no problem. I fully utilize my credit cards every single month and then I pay it off. Well, from my perspective, if I get that information up front, I am actually worried that there is a problem, because depending on the timing of when we go ahead and pull your credit, it is going to look bad. Or like Stephen was saying, if you're always doing it after you received your bill in the mail, then it is going to look bad. And we need to make sure that we're being mindful of that, because while we can always contend with paying off a credit card balance if we need to get your debt to income ratio in line, which I'll talk about in a second, while that is true, your credit score is not something we're going to be able to change that quickly. So you're going to be stuck with the scores that reflect, 30% going into the score model is your debt ratio. You'll be stuck with the scores that reflect this high utilization. And even if we have you pay off that balance in full at closing, or show that you paid it off in full just before closing if you need to, it's not going to help with your scores. It's only going to help with your debt to income ratio. The difference between the two is that your debt to income ratio is the relationship between all of the debt that is appearing on your credit report, minimum payments only, not the actual balances, but the minimum monthly payments owed for each individual debt, plus your future mortgage payment in relationship to the amount of income that you're taking in each month. If we add up and tally up all of those monthly payments plus the new proposed mortgage payment and divide that into the income that you have coming into your household, and that percentage is too high, you aren't going to be eligible for a mortgage, or you're not going to be eligible for, I should rephrase, you're not going to be eligible for a mortgage at the amount that you might want or prefer or need. And so we can get creative sometimes, and we can have you pay off some debts at closing that actually, make a huge difference. And you'll get a really big bang for your buck without necessarily having to spend a lot to get there. But again, it's so important that you don't just run and go take care of those things before talking to me first. Oftentimes, when I'm looking at someone's credit report, I can offer a solution for you that we can tackle very quickly and easily, and maybe it only costs you $800. But you were focused on other trade lines with much larger balances. You blew through or burned through liquid cash to take care of those, and the minimum payments on those trade lines are very small and don't actually help us much at all when it comes to getting your loan approved. The other thing I will say is that for people who maybe are in a little bit of a tighter situation when it comes to your debt to income ratios, we're only going to make you or have you pay off what is absolutely necessary. So as we move through the loan process, maybe things will change. Maybe the amount of verified income that we have on file goes up. Maybe the interest rate offer comes down, and so you have a lower monthly payment now. Maybe what we were forecasting for homeowners insurance was actually too conservative, and you got a really competitive price on a homeowners insurance premium. All of these things can impact your debt to income ratios and put you in a position where maybe at the beginning of the process, just to make sure that we were level setting on expectations, I told you, worst case, you'll need to pay an extra $3,000 at closing to take care of these debts. But by the time we start approaching closing day, I can confirm to you, you actually don't have to pay off anything at all. If you still want to, that's perfectly fine, but we're not going to ask you to or require you to in connection with loan approval. And so that's why I don't want people running around and paying things down, because one, it's probably not going to make as much of an impact as you think it would. And two, you could be doing it entirely unnecessarily. If you close on the home, you get into the house, everything's all good, you're in there for 2 weeks, you figure out that you don't really need anything extra beyond what you had anticipated, and you still want to go pay off $3,000 worth of debt, fantastic. I wouldn't stop you. I love when people pay off debt. I think that's great. But it might not be necessary, and you could get into that house and realize that you do actually need something, or you do have an expense that you weren't anticipating. And so at all times, we're going to try to preserve your liquid cash, and make sure that we're not asking you to draw on that unless it's absolutely needed for loan approval.
Absolutely. And the one last thing you were talking about, don't just go and do things. The other thing you don't want to do is close your credit cards. And I get that a lot. People are saying, oh, this whole system's so screwy. I'm just going to close my credit cards. I can't handle it, right? Closing your credit cards can be significantly damaging to your credit, and people don't even realize it. And I actually just gave a class a couple of weeks ago, and one of the audience participants said, well, if they close it, meaning if the bank closes it on me and it's not my fault, they're closing it, well, then it doesn't hurt me, right? Not true. Whether the bank closes it or you close it, that doesn't really matter. A closed card is a closed card is a closed card, and it's still going to negatively impact you. Think of it this way. Let's say you have a $1,000 credit card and a $1,000 credit card. So you have $2,000 in limits. And this credit card, you max out every month, you owe $1,000. But this credit card has a zero balance. It's just sitting in your drawer and you never use it. Well, after 6 months of non-use, guess what? The company thinks this person doesn't want this card anymore. Now it goes away. Well, before we were at 50% utilization. Now when it goes away, we're at 100% utilization. And our score just went down 20 to 25 points simply because the credit card got closed. So the small things that you might not think make a difference, like that, oh, I haven't been at Target for the past year. Go shop at Target. Go buy a pair of socks, which is probably a bad example. Everybody shops at Target all the time. But point is, you want to keep these cards open and active, because if they do get closed, Generally speaking, after 6 months, again, sometimes like a store card, you might get like up to a year to be able to use it, but you have to keep them open and active because if you don't, it could cause big problems. So let's keep going through this. I know we have a lot to get through still. The average age of the credit file, I'm just going to kind of sprint through a couple of these things. The average age of the credit file is looking for that longevity. So whereas we don't want to be closing accounts, we don't also want to be opening accounts constantly because every time you're opening up an account, that's going to lower that average age of the credit file. And for the people thinking, yeah, well, I like to get my 30% off when I go holiday shopping, right? And so they apply for the credit card, you get your 30% off. The next month, you get your bill, you pay it in full, you close the account. Well, there you go. The account is closed now. It's not going to hurt my average age anymore, right? Not true. Whether an account is opened or closed, if it's on your credit report, it's still impacting the average age. And a lot of people don't realize that. So you don't want to constantly open and close accounts because that will lower that average age of the credit file. By the way, when we're talking about the authorized user, not only can that help that debt utilization aspect, but it can also help here in terms of the average age of the file. That's why when you do get added as an authorized user, you want a card that's at least 5, 10, 15 years old, not a card that's been open for 6 or 12 months. That's really not going to help with the average age. The next is the 10% of our score being the mix of credit, meaning the FICO scoring system just wants to see a couple variety, different types of accounts, a mortgage, a home equity line of credit, auto loan, student loans, 3 to 5 credit cards, right? So you might be in a situation where you say, oh, well, I only have 1 credit card, so I guess I should open up 2 more. Oh, hold on 1 second. What are you looking to do? Well, I want to be able to buy a house in the next 2 months with Alyssa. Well, guess what? You're not going to open up any new credit cards because if you do, although it's helping your mix of credit, you're lowering the average age of your credit file. And as we're about to see, you're going to take it for that inquiry. So don't do anything with your credit when you're about to be using it in the next 6 to 12 months, especially the next 3 to 6 months. But really in that 6 to 12 months, you want to give yourself that window. So if you are making any changes, it has time to catch up with the system and actually help you. Conversely, if you have 5 open active credit cards, should you go close 3 of them? Absolutely not. We literally just talked about we don't want to be closing credit cards because you might say, well, those 3 credit cards are the ones I never use. Yeah, but all that extra limit that's sitting there is helping our overall utilization. And if you close those 3 credit cards just to help the perfect mix of credit, it could be causing bigger problems on the debt utilization side of things. So don't close credit cards either if you're about to try to qualify for something. And then the last 10% is inquiries. Anytime you apply for something, it's going to count as an inquiry. So you're applying for a piece of financing. So every time you apply for a credit card, that's going to count as an inquiry. So if you apply for 5 credit cards this month, guess what? You have 5 inquiries, your score is going to go down 5 times. However, with mortgages and with auto loans, you have a 30-day window, 2 separate windows, one for auto, one for mortgages. You have a 30-day window to go shopping, and it only counts as 1 inquiry. So if you go shopping and the dealership pulls your credit 5 times, and then this weekend they pull it another 8 times, and then another dealership next week, they pull it another 10 times, and now you have over 20 inquiries within the next 3 weeks of all these auto inquiries. Well, guess what? All of them will be listed, but it only impacts your score once. So that's perfectly okay to do that if you're shopping around, and you don't have to worry about that dragging your scores down. So those are the components. Alyssa, any last thoughts on any of those?
No, I think I'll just let you get through these ones.
Perfect. I'm not going to do the deep dive in this. Here's the bottom line with this screen. All it's basically showing you is that if you have great credit, you don't pay very much in interest, and therefore you're putting more money in your pocket. Mm-hmm. However, if your credit's not so good, maybe through late payments, maybe through high utilization, like having those high balances on the credit cards, or maybe you've had multiple late payments, or even something that went to collection, where the more negative stuff that's going on, the more your score is going to go low. The lower your score, the higher interest rates are going to be. And bottom line is, the higher the interest rates are, the more we're just giving money to the bank. So that's just kind of the overview on this one here. Last thing I'm going to be talking about, and then I'll pass it over to Alyssa because I know you got some good mortgage stuff to talk about, is just the upcoming changes. And I think this is really important to understand that the system we've been using over the past 26 years, that FICO Classic, has been the gold standard. That is what the mortgage companies use, and that is what they have used since the year 2000, and that's fine. However, we are going to see upcoming changes where we do go from this FICO Classic system into something known as FICO 10T, which is the newest version as FICO, as well as Vantage 4.0. Vantage 4.0, Vantage scores, just so you understand, are the main competitor to FICO scores, and they will now, in the near future, let's call it the next 12 to 24 months, be able to be used in mortgage lending. So if we know that this is coming and we know that it's going to be in the next 12 to 24 months, why do we need to focus on it today? Well, because of those two words right there on the screen, trending data. Trending data is going to be an absolute game changer when this comes live, because what that says is, in the current model, we're looking at your revolving debt on a month-to-month-to-month basis. So we talked earlier about if you have high credit cards and you pay them down to zero or as low as you can, and then you wait 30 days, your scores can go up 20, 30, 40, 50 points because you're paying down your debt utilization, your debt ratio, right? Well, with trending data, that all goes out the window, because with the trending data and the new system, it says, we don't care what's happening this month. We want to know, how have you been using your revolving credit cards over the past 24 months? Meaning they really want to look at that history. So if you think about it and we say, well, let's say this goes live in December of 2027. And as soon as it goes live, it pulls back our past 24 months of revolving history. How you're paying your credit card now is going to dictate what your scores look like 2 years from now. So it's really important that we start changing the way that we're spending money, that we have these habits of having these high utilization, because if we don't make those adjustments, it's going to be a huge problem. And this is just a real life example where somebody in the current model, you can see the top score there shows a 706. They had borrowed money from their uncle. They paid down their debt. Their scores jumped up to a 706. They were able to get the loan. But when I went back and I looked at their FICO 10T score, that trending data score, it showed that they were somebody that constantly had high utilization. And in doing so, if the new scoring model was put in place, they wouldn't be at a 706, they'd really be at a 643. So understanding that this is coming and we have to be prepared for it is the most important thing that we can do to make sure that we're headed in the right direction. And we have to understand that as a nation, right now, we have the highest credit card debt that we've ever had. And they're about to implement a system that specifically looks at how we're managing our debt on revolving accounts. So it's something that we really need to make these adjustments. Otherwise, we're going to be in trouble when it goes live. So with that being said, I'm kind of wrapped up with my information. If anybody has any questions, you can certainly reach out to me, and I'm happy to answer those. But I do want to get it back over to Alyssa so she can tell us a little bit more on the mortgage side of things.
Perfect. Thank you. And let's see. Yeah, if you can click through, and that's a perfect one to stop on, that would be great. So this slide is intended just to show you guys how low we can actually go with credit scores for certain products. So we're covering government-backed loans in this slide, FHA, VA, USDA. Obviously, the bread and butter of mortgages, the conventional loan, doesn't appear on here. But for people who are seeking those loan products that have notoriously lower down payment options, or are more flexible when it comes to overall debt to income ratio or credit scores, these are going to be the three that we would be eyeing. Now, you'll notice that for the FHA loan, we can technically go as low as 500 on your credit score and still approve you for a mortgage. Little bit of a nuanced thing that isn't notated on this slide, but something to be aware of. If you do have a score as low as 500, you will not be able to purchase a home with just 3.5% down. In order to approve you, you have to put at least 10% down, but we can go as low as 500. Anything above 580 is going to enable you to purchase a property with a minimum down payment of 3.5%. And 580 or higher is great. So if you're, sometimes I get calls from people who tell me when I ask that question about credit, oh, my credit scores are really terrible. And I say, okay, well, what's really terrible to you? Because I want to get a sense of what the scores are. And they'll say, I think they're around 670, 680. Well, 670, 680 isn't really terrible for purposes of securing a home loan. You can purchase a property. There are a number of products that would be available to you. Are you going to get the best interest rate offering for a conventional mortgage? Probably not. Are you going to be able to get really competitive offers, though, still for an FHA loan, a VA loan, if you qualify for that mortgage product, or potentially a USDA loan? Yeah, maybe. And it could make a lot of sense. So, again, all the more reason why it's important to reach out as early as possible once you think that you are in the market for a home or might want to be in the market for a home. And same thing for the VA and USDA products. We can go as low as 500 on VA. That product is really attractive if you qualify for a VA loan, because you can put no money down and you don't have to pay any private mortgage insurance. And on the USDA loan, you don't have to put any money down. The private mortgage insurance, technically, it's called something a little bit different, is generally lower than what we see on most loan products, and they'll accept a credit score as low as 620. There's a few other things that we have to be aware of with the USDA loan. You're not going to be eligible for that type of financing unless you're buying in a rural area, which is defined by a federal map. But this slide is intended to show you guys that you do not have to have stellar credit, 800 credit scores to be able to get approved for a loan. And as a matter of fact, you don't even have to have an 800 credit score to be able to access all of the best rates and pricing available. As a general rule, as long as your credit mid score, meaning the middle score of the three bureaus, is 760 or higher, that is going to enable you, at least at CrossCountry, to be able to access all of the best rates and pricing that we offer across all loan products. If you go to the next slide. And I mentioned this earlier, but in case you missed it, we can take a look at your credit scores and all of your credit history with just a soft pull. So there's no detriment to you or your credit. We do not have to perform a hard inquiry and then do it again once you get under contract on a property, and then maybe do it again depending on the closing timeline to refresh once more before closing. We can run all of your numbers, give you advice on what products you're eligible for, connect you with Steven if there are things that you need to work on with just that soft inquiry or soft pull of your credit, to be able to get a really holistic picture of where things stand. It'll be as if we never pulled your credit in connection with a mortgage. So when Stephen was talking earlier about getting your credit pulled and not having an impact on your score, but you will see the creditors on your credit report. In this case, you should not even see our name pop up on your credit report. If you were to take a look at it, it will be as if we never did an inquiry against your credit.
Yeah, and that's a huge thing that they've come out with the past few years, is its ability to pull that soft pull. So definitely take advantage of that, because now you're not having to go to my FICO directly, but you're being able to see from the lender side where your scores are.
And this is a really great kind of worksheet, just so that you guys can get eyes on it. We're going to send it out as a follow-up email after the event as well. But if you are trying to really get a handle on your finances, trying to get a handle on what you're going to be able to afford, and you've really never given a lot of thought to, what do I have for outstanding payments on my credit report? Plus, what am I spending or pushing out the door every single month on some of these other incidentals? Not all of these items are going to show up on your credit report, right? So rent, mortgage payments, auto payments, student loans, credit cards will show up on your credit report. But for the most part, none of these other items are going to show up on your credit report. All we're looking at is the minimum monthly payments on your credit report. But it's really important for you to have a handle on what's going out the door in all of these other categories, because when I'm giving you a mortgage pre-approval or telling you what you qualify for, what you can afford in the eyes of the powers that be offering these types of loan products, that's just based off of what we can see on your credit report and your new proposed mortgage payment. only you know if you love going out to a Michelin rated restaurant every quarter for a dinner. Only you know if you like to take a really awesome vacation every single year or twice a year. If you have unlimited data, all the bells and whistles, all the newest iPhones on your family plan, and your cell phone bill is astronomical, we're not going to see any of that. But those are things that you do need to take into account when you're getting ready to purchase a home, and when you're trying to get an initial handle on your finances before you purchase a home, which I would highly recommend you do, either before you speak to a loan officer or immediately after speaking with a loan officer. And next slide. We will send out this as well as a follow-up, but this is a helpful key so that you can start to get an idea of what your monthly mortgage payment would look like, based off of different types of scenarios. This grid is going to show you principal and interest portions of the payment only. You are still going to be responsible for a mortgage. For a property, you're going to still be responsible for taxes, real estate taxes, homeowners insurance, and depending on the loan product that you're in, private mortgage insurance. So those are all things that need to be considered as well. It's not just the principal and interest payment, but this does give you a really good baseline as to what a monthly payment could look like for you. And we will make sure when we're talking to you about your loan pre-approval that when we're giving you figures, we're also building in insurance, taxes, and the private mortgage insurance that I touched on a little bit earlier. HOA fees as well. That's not necessarily something that we will build into our monthly payment or will impact qualifying for you, but it is something that you need to be prepared for, and it is a real monthly expense that you will be responsible for if you purchase a condo or a townhome with HOA. All right. I was going to say, I thought that's all we had.
That's it.
So thank you guys so much for joining us. I hope that you found this incredibly valuable and helpful. Doesn't look like that we have any questions in the chat queue, but you have my contact information and Steven's contact information up there on the slide. We'll make sure that you guys have a copy of this slide deck as well as those attachments that I mentioned a few minutes ago. I'll be sure to follow up with each and every one of you via email. So if you do have questions that you'd rather flow offline, questions about your specific credit scenario, always happy to field those and connect you with Steven if needed. Like I said, I like to stay in my lane. So generally speaking, I will connect you with him, or feel free to always reach out to Steven on your own accord. His office number and his cell phone number are listed up there. He's a phenomenal resource. He's who I go to, he's who I'm going to send you to. So if you want to go straight to the source right away, I would highly encourage you to do so.
Excellent. Well, Alyssa, thank you so much for having me on today. I think this has been fantastic. We covered a lot of good information in regards to credit and the home buying process. And I think having a team like this, where I can work on the credit side, you know a lot more than you think you do, and probably from working with me for the years that we have been working together. But of course, always happy to speak with your clients if they want to come directly to me or through you. That's fine as well. And just always want to be a resource to be able to answer any credit questions going forward.
Awesome. Well, thank you so much, Steven. We appreciate you. And thank you guys for joining, and have a great rest of your evening.